In the autumn of 1929, the United States stood at the pinnacle of a financial empire built on debt, speculation, and an unshakable belief that prosperity was permanent. Just 95 years later, in 2024, America finds itself standing in the exact same place. The names have changed, the technology has evolved, but the fundamental patterns driving economic collapse remain eerily identical. History doesn't repeat itself, but it does rhyme with devastating precision. The distance between the crash of 1929 and our current moment is not measured in years, but in cycles. Specifically, an 80-year pattern that has governed the rise and fall of American wealth since the nation's founding. This is not speculation or theory. It is documented economic reality, visible in the data, traceable through legislation, and predictable in its consequences. Economic historians have long observed what researchers call the Kondratiev wave, long-term cycles lasting between 40 to 60 years that govern capitalist economies through alternating periods of prosperity and crisis. But embedded within these waves lies an even more profound pattern. The 80-year cycle, sometimes called the fourth turning, which tracks the complete arc from crisis to crisis across approximately 4 generations. From the Revolutionary War era to the Civil War, from the Civil War to World War II, and from World War II to today, American history moves in roughly 80-year intervals punctuated by transformative upheaval. What makes this cycle so powerful is its human component. Each generation forgets the lessons learned by their great-grandparents, creating what economists call institutional amnesia. The generation that lived through the Great Depression understood viscerally the dangers of excessive debt, reckless speculation, and isolationist trade policy. But by 2020, those who remembered the 1930s were gone, and with them went the collective memory of what happens when you repeat their mistakes. The mathematics of the cycle are straightforward. The stock market crash occurred in October 1929, triggering a depression that wouldn't fully end until World War II mobilization in the early 1940s. Add 80 years to 1929, and you arrive at 2009, the year of America's second worst financial crisis. Add another 15 years, accounting for the lag between warning signs and full collapse, and you reach 2024. We are not approaching the repetition of history's mistakes. We are living inside them right now. The architecture of the 1929 crash was built on 3 foundational pillars, each seeming rational in isolation, but catastrophic in combination. Understanding these pillars is essential because America has reconstructed them with remarkable fidelity in the past 15 years. The first pillar was unprecedented wealth concentration, with the richest, 1%, controlling 23.9% of all income by 1928, a level not seen before in American history. This concentration meant that the broader economy depended on the continued spending of a tiny elite whose fortunes were tied almost entirely to stock market valuations. The second pillar was the explosion of consumer credit and speculative borrowing, particularly margin loans for stock purchases. By August 1929, brokers had lent more than $8.5 billion to investors buying stocks on margin, money these investors could not repay if share prices declined. When margin loans accounted for 20% of the entire New York Stock Exchange's market value, the system had become a house of cards waiting for the slightest breeze. 1 in 6 Americans owned stock by 1929, up from 1 in 20 in 1920. Most of these new investors understood nothing about the actual value of the companies they owned. The third pillar was the catastrophic policy response embodied in the Smoot-Hawley Tariff Act of 1930. Signed into law on June 17, 1930, this legislation raised tariffs on over 20,000 imported goods by approximately 20%, ostensibly to protect American jobs in manufacturing. The result was economic devastation on a global scale. U.S. exports collapsed from $7 billion in 1929 to $2.5 billion in 1932, a 64% decline in just 3 years. Farm exports fell by 1/3. And international trade plummeted 65% as nation after nation retaliated with their own tariffs. The human cost was staggering beyond comprehension. Between 1930 and 1933, more than 9,000 American banks failed, obliterating $1.3 billion in depositor savings, equivalent to $28 billion in 2024 dollars. There was no Federal Deposit Insurance Corporation, no government safety net, no bailout. 20% of all bank deposits simply vanished, taking with them the life savings of millions of families. Unemployment reached 25% by 1933, but this figure understates the reality. Millions more worked part-time or for wages that couldn't support basic survival. The Federal Reserve's response deepened the catastrophe rather than containing it. In 1928 and 1929, the Fed raised interest rates to curb stock market speculation, inadvertently choking off credit to the real economy. After the crash, instead of flooding the system with liquidity, the Fed allowed the money supply to contract by over 30% between 1929 and 1932. This monetary contraction transformed a stock market crash into a full-scale depression, destroying industrial production and crushing any hope of recovery. The parallels between 1929 and 2024 are not approximate, they are precise. Begin with wealth concentration, the first pillar of the 1929 disaster. As of the first quarter of 2024, the top 1% of American households hold 30.8% of all wealth, a figure that has risen steadily from 22.8% in 1989. This level of concentration now exceeds even the 1920s peak. The top 1% collectively hold $52 trillion in wealth, an increase of $4 trillion in 2024 alone, while the bottom 50% of households hold just 2.5% of national wealth. The concentration at the very top has reached levels that defy historical comparison. In 2024, America's 19 richest billionaires, representing just 0.1% of the population, increased their collective wealth by $1 trillion, bringing their total to approximately $2.6 trillion. This means that 19 individuals control wealth equivalent to roughly 10% of annual U.S. GDP. When economic stability depends on the spending patterns of a microscopic elite, the system becomes inherently fragile. Consumer debt levels have exploded to record highs, recreating the second pillar of 1929. Total U.S. household debt reached $18.59 trillion in the third quarter of 2024, with credit card debt alone totaling $1.21 trillion, a 7.3% increase from the previous year. The average American household now carries $105,056 in total debt across mortgages, auto loans, student debt, and credit cards. This is not productive investment. It is consumption funded by borrowing, a pattern that becomes unsustainable the moment interest rates rise or employment falters. Corporate America has gorged on debt with equal abandon. The number of zombie companies, firms that can barely cover their interest payments and would fail without continued access to cheap credit, has surged to 2,270 globally as of 2023, an 8.9% annual increase. In the United States, corporate default risk reached 9.2% in 2025, the highest level since the 2008 financial crisis. These zombie firms survive only because of the decade of near-zero interest rates from 2009 to 2021, and many are now collapsing as borrowing costs normalize. The Federal Reserve's monetary policy from 2020 to 2022 mirrored the reckless expansion of the late 1920s. In response to the pandemic, the Fed expanded its balance sheet by trillions of dollars while keeping interest rates at zero, flooding the economy with cheap money that inflated asset prices to unsustainable levels. When inflation surged to 9.1% in June 2022, the highest rate in 40 years, the Fed executed the fastest interest rate tightening cycle in modern history, raising rates by 525 basis points between March 2022 and August 2023. This whiplash in monetary policy had predictable consequences. In March 2023, Silicon Valley Bank collapsed after losing $1.8 billion on underwater bond holdings, becoming the second largest bank failure in American history. 2 days later, regulators closed Signature Bank. And by May, First Republic Bank had failed as well. These regional bank failures wiped out $549 billion in deposits within weeks, requiring emergency FDIC intervention and Federal Reserve liquidity support to prevent a 1930s-style cascade of bank runs. But it is the resurrection of protectionist trade policy, the third pillar, that makes the historical parallel most chilling. Between 2018 and 2025, the United States imposed tariffs on hundreds of billions of dollars in imports, primarily targeting China, but extending to steel, aluminum, and numerous other goods. By the end of 2024, American importers had paid over $260 billion in trade war duties. The effective tariff rate jumped from 2.3% at the start of 2025 to 9.7% by mid-year, representing the largest tax increase as a percentage of GDP since 1993. Economic analysis estimates that these tariffs will reduce U.S. GDP by 0.5%, while raising prices for American consumers by an average of $3,800 per household annually. Foreign retaliation has already begun, with China, the European Union, and other trading partners imposing their own reciprocal tariffs on American exports. U.S. farm exports have declined significantly, manufacturing employment has not recovered to pre-pandemic levels, and supply chains remain disrupted. The pattern is following the 1930s script, with disturbing fidelity. Protectionism intended to save jobs instead destroys them by collapsing international trade. Economic cycles do not end because people wish them away. They end when the structural imbalances that created them are violently corrected. The 80-year pattern suggests we are not at the beginning of a crisis, but deep into its middle phase, with the most severe consequences still ahead. History provides a clear roadmap of what comes next if the pattern continues to hold. The first implication is the high probability of a major recession or depression within the next 2 to 5 years. The combination of record household debt, elevated corporate leverage, concentrated wealth, and restrictive trade policy creates what economists call a debt deflation trap. As asset prices fall, which they inevitably will when debt becomes unsustainable, the value of collateral backing all those loans collapses. Banks contract lending, businesses cut investment and employment, and consumers reduce spending, creating a self-reinforcing downward spiral. The zombie companies currently surviving on access to credit will fail in large numbers. With corporate default risk already at 9.2% and rising, even a moderate recession could trigger a cascade of bankruptcies across over-leveraged firms. This will destroy jobs, wipe out equity investments, and potentially trigger another banking crisis as loan losses mount. The 2023 regional bank failures were an early warning, not the main event. The global trade system faces potential disintegration if protectionist policies continue to escalate. When the Smoot-Hawley tariffs triggered retaliatory measures in 1930, world trade collapsed by 2/3 within 3 years. Modern supply chains are far more integrated and complex than in the 1930s, which means disruption could be even more severe. A breakdown in international trade would devastate export-dependent industries, raise prices on countless consumer goods, and eliminate millions of jobs worldwide. Social and political instability will accelerate as economic conditions deteriorate. The 1930s did not merely produce economic depression. They gave rise to authoritarianism, nationalism, and eventually global war. When populations face sustained unemployment, lost savings, and declining living standards, they gravitate toward radical political solutions and scapegoating of outsiders. The United States has already witnessed increasing political polarization, erosion of democratic norms, and social fragmentation. Economic crisis will amplify these trends dangerously. The timeline for these events is constrained by the cycle itself. If the pattern holds, the crisis period that began around 2008 should reach its climax between 2025 and 2030, corresponding to roughly 80 years after World War II and the resolution of the last great crisis. This does not mean collapse happens on a specific date. Cycles are not that precise, but it does mean the window of opportunity to change course is rapidly closing. The indicators are already flashing red across every major economic metric. The conventional narrative about economic cycles emphasizes their unpredictability, the idea that this time is different and past patterns cannot predict future outcomes. This narrative is comforting but wrong. The 80-year cycle is not mysticism or coincidence. It is the documented result of generational memory loss combined with structural economic forces that have not fundamentally changed in centuries. When societies forget the lessons learned through catastrophic failure, they recreate the conditions that produced that failure with eerie precision. The contrarian insight is this: the cycle can be broken, but only through conscious collective action informed by historical understanding. The United States did not have to pass the Smoot-Hawley tariff in 1930. Hundreds of economists warned Congress in writing that it would be catastrophic, and they were ignored. The Federal Reserve did not have to contract the money supply after 1929. Alternative monetary policies were available but not pursued. Banks did not have to operate without deposit insurance or regulatory oversight. These institutions were created only after disaster forced their adoption. Every element of the 1930s catastrophe was a choice, not an inevitability. And every element of our current trajectory is equally a choice. The decision to maintain extreme wealth concentration through tax policy is a choice. The decision to allow household and corporate debt to reach unsustainable levels is a choice. The decision to embrace protectionist trade policy, despite overwhelming historical evidence of its destructive consequences, is a choice. Breaking the cycle requires doing what previous generations failed to do, learning from history before being forced to repeat it. This means aggressive redistribution of concentrated wealth through progressive taxation, systematic reduction of household and corporate debt levels, robust financial regulation to prevent speculative excess, and rejection of protectionist policies in favor of cooperative international trade frameworks. These solutions are not radical. They are precisely what the United States implemented after World War II, creating the most broadly shared prosperity in American history. The 80-year cycle teaches us that we stand exactly where our great-grandparents stood in 1929, at the edge of an avoidable disaster. Whether we step back from that edge or march forward into the abyss is the defining choice of this generation. History has given us the answer key to the test. The only question is whether we are wise enough to use it.